Attention shoppers! Attention shoppers! Everything is 40% off. I repeat, everything here is 40% off. You will never see a cheaper price in another 10 years.
When the supermarket goes on 40% discount, will you rush there immediately? Of course you will. Now this is the best time to overbuy and stock up for future use. Investing is the same. When stocks are cheap, it's time to buy. Or is it? You should buy stocks when they are cheap. How often do you hear this advice? On the surface, it makes perfect sense. Just like the supermarket discount, when stocks are cheap, you buy. When stocks are expensive, you sell. Buy low, sell high. That's the secret of the stock market. Knowing this secret, why are we all not millionaires? Not so fast. Before we jump to conclusion, let's dig deeper. The best way to find out is to put this theory to the test. I will reference Samuel Dee's research. All credits goes to Samuel Dee and his research. I just compile it into an exciting YouTube video for you to enjoy, and I take no credit for his work. In his research, he ran simulations using money US stock market total returns from the mid-1926 to the end of 2016, buying the dip. We assume as an investor, we will practice buy the dip strategy. The investor will wait for prices to fall and buy whenever there is a correction. We will define a correction as 10% decline from the peak. Essentially, there is a 10% discount from the peak. After buying, we need to define some sell rules. We will have the investor hold the stock for at least 12 months. After 12 months, if the price is still below the investor's buy price, the investor will treat this as a long-term investment. We do this because most people are loss adverse. When they have paper losses, they do not want to lose money and they will hang on dearly to the stock in the hopes of recovery. So our investor will hang on until the price recovers to his initial buy point and sell there, getting out at break-even price. Results. So with this strategy, here are the results. It looks quite profitable. If you started with $100, you end up with about $850 after 88 years. But hang on, let's put these results into perspective and do some benchmarking. If we were to analyze the performance, timing the market to buy only after a 10% decline would have returned 2.2% annualized. We also look at the standard deviation. The standard deviation is a measure of risk. The more the portfolio fluctuates up and down, the higher the risk. The standard deviation is around 15.74%. This means there's a good chance of your investment returns jumping around and you may make losses or gains. The risk goes both ways, but if you don't quite understand statistics, it's okay. Just bear this 15.74% number in mind. The higher this number is, the riskier the investment is. We like to have this number to be as low as possible. First off, let's compare this with the S&P 500 benchmark. If you were to buy and hold, our annualized return will be 6.3% and the standard deviation is 18.6%. So 2.2% versus 6.3% may seem like a small difference, but bear in mind, these are compounded numbers where each year's gain will boost the next year's gain. If you stretch this over 88 years, the final difference is huge. For further comparison, let's use the 10-year Treasury note. Treasury notes are considered risk-free because they are backed by the government. The annualized return for a 10-year Treasury note since 1926 was about 5.3% with a standard deviation of 5.7%. So the bottom line is that if you had used this strategy, you're taking on more risk and getting much lesser return. Waiting for market crash. Let us tweak the strategy further. So far we know that buying the market dip has proven to be a lousy strategy. Perhaps we didn't buy low enough. I'm sure you have heard numerous advice on buying the market crash. Baron Rothschild famously said, buy when there's blood on the street, even if the blood is your own. On the surface, it makes sense. When the market crashes, you get great discounts, and that's probably the lowest price it will ever be. So let's put that theory to the test. We shall buy during market crashes. We will wait until there is a big outright market crash, a drop of 10 to 20% from the peak. is just a correction. We will buy when the drop is deeper. We will define a market crash to be around 40% decline from the peak. According to Samuel Lee's research, the results are actually no better. If we buy after a 40% crash from the peak, our annual return will only be 1.79%, lesser than the 2.2% if we were to buy after a 10% crash. Reasons why and how. The research gave two possible reasons why the correction timing strategy fails in the long run. The first reason could be due to having not a lot of opportunities to deploy the cash. Much of the time, the investor's cash is sitting on the sidelines not doing anything. It generates 0% return, whereby if the cash had been deployed in the market, the investor would have earned some premiums for taking the risk. The second reason could be due to the strategy of buying during corrections and crashes. Assume that the market reverts to the mean. It assumes that anything goes up will eventually come down, right to where it started. Unfortunately, in the past 88 years of history during the research, the market showed momentum instead of mean reversion. That means the market has a persistent trend in the upwards direction all this time. On hindsight, a trend following strategy would probably have worked better. Do you disagree or agree with the research? Subscribe, leave a like and comment down below, and I will see you in the next video.